Hello, everyone, and welcome. My name is Elliot Gu, and welcome to our first webinar of the new year, Energy's New Supercycle. It's January 2nd, 2 p.m. Eastern Time. Happy New Year to everyone. Looks like we still have quite a few people who are just logging in. Quite a few participants are just logging in. So I'm going to just get through some housekeeping notes while those of you who have yet to log in have a chance to get into the webinar. First of all, this webinar is being recorded. So we will have a recorded version of it that we can link you to after this webinar is finished. Probably tomorrow morning we'll send you out a link via the email address you used to register with a link to the recorded version. So don't worry if you have to leave early because you can always check it out, check out the remainder or anything you missed via that recording link. In addition, we will send you a copy of our slide deck in PDF format probably later on tonight or again first thing in the morning. We both have, I'm joined of course by my good friend and co-founder of Energy and Income Advisor, Roger Conrad. We both have some prepared slides, prepared remarks and slides to show you. And then of course we will be opening it up to questions and answers. If you'd like to ask a question, you can actually do so at any time. Just click that box on your screen that says Q&A. Or you can use the chat function if you prefer. Type in your question. It's a text system, so type in your question. And then at the end of our presentation, after we finish our prepared remarks, we'll go ahead and read your question and then answer it live on today's webinar. And again, you can go ahead and ask a question anytime you wish. Of course, we will get to all the questions as soon as the prepared remarks are finished. You know, if you have to leave early and you want to ask a question, also not a problem because you can listen to the answer on the recording. So with that, I guess we'll go ahead and get started. The first slide here, of course, on your screen, just to let you know, we are also offering, we are raising the price of Energy and Income Advisor this year, now 2020, but as a special sort of New Year's offer, we've got special trial memberships for Energy and Income Advisor available via that website you see on your screen. December 19th, the December 19th special offer link. I'll put it up a little later on. But the long and short of it is the price will be going up to $9.99 shortly. But we're still offering annual subscriptions for $6.49 and quarterly subscriptions for $194. So we're still offering through this Sunday night, this coming Sunday night, the same rate we've been charging throughout 2019. In addition, normally we offer a 30-day money-back guarantee. You know, try the service for 30 days. If you don't like it, cancel, get a full refund. However, we've decided to extend that to 90 full days, so you have 3 full months. Sign up via that link over the next few days. As I said, it all ends on Sunday night, and we will give you 90 full days to test drive the service. Check out all our model portfolios, all the issues we send out, all our alerts. Also, you'll be able to participate in our monthly Q&A chats, which is, we do that every month in Energy and Income Advisor, where you can type in your questions about anything, the market, individual stocks, you know, whatever you want to ask that we can answer, that we're qualified to answer anyway, and we answer it right on the chat. So the next one will be coming up sort of towards the end of this month, but if you sign up, you have 90 days to try it, so you'll be able to participate in the next 3 of those. Why are we doing this today? Well, it's our view that energy, commodities, in particular oil, mainly oil, are in the early stages of a new upcycle. Oil, as many of you know, is a commodity which moves in very long-term cycles. You know, when I first got into the energy market, started studying the energy markets and focusing on that industry group, a little over 20 years ago, we were coming out of a down cycle that had lasted throughout much of the 1990s. And in the early years of a new upcycle in oil that saw oil prices rise from $10 and change back in December of 1998, all the way up to 150 bucks a barrel in 2008 over that 10-year upcycle. Since 2014, of course, we've had a down cycle, a 5-year bear market in oil. We believe last year, 2019, kind of marked the end of that. And we're now in the early stages of a new upcycle. In addition, energy stocks are way out of favor right now. It was the worst performing industry group in the S&P last year and the year before, actually. So these stocks are cheap. They're actually record cheap, relative, as I'll show you in a minute, relative to the rest of the stock market. And one of the things that you'll find over time is that some of your most profitable investments will be those that are in cheap, out of favor sectors, sectors where the consensus is very bearish. You know, Wall Street is generally very bearish on the group, and they're very out of favor, very cheap, yet there are some positive changes underway under the surface that are being widely ignored. That's a very, very profitable long-term setup for investors because you're able to buy these assets, you know, at pennies on the dollar and then benefit as the fundamental shifts underway become more evident to the crowd and the crowd starts to jump back into energy stocks. So with that, we think this is a great buying opportunity in energy, and we're going to kind of go through not only why we believe that's the case. I'm going to talk a little bit about oil, talk a little bit about specific stocks, and then Roger's going to talk a little bit about some income stocks in the energy market that we like as well. So let's go ahead and get started. Let me move over here to my first slide. Hopefully you can see my slides okay. As I mentioned, energy is extraordinarily out of favor. This is the market weighting in the S&P 500 for energy stocks. So the energy stocks back in 2000 accounted for sort of upper 5 to around 6% of the S&P 500. So out of the entire index weight back in 2000, energy accounted for about just 6% of the total S&P 500. As I said, that's 20 years ago roughly. When I got started following this market closely, energy was out of favor, very much like it is right now. Oil prices were under 20 bucks a barrel. Obviously, as we saw that big shift in the oil market towards a bull market again, due partly, mainly to a surge in demand from emerging markets, oil prices ran all the way up to $150 a barrel. And of course, in 2008, in the middle of 2008, people couldn't get enough of energy stocks. And energy made up about 16% of the S&P 500. So over the period from 2000 up until 2008, energy's share of the S&P 500 basically tripled. Now, if you look at what's happened since then, and in particular what's happened since 2014, when oil prices started coming down, energy's weight in the S&P 500 has plummeted to about just 4.1% of the S&P 500. That's a record low for energy's weight in the S&P 500. Another way of looking at valuations that I like to look at, relative valuations, is this is simply a chart that shows the price to book ratio, which is a valuation metric for the S&P 500 energy index, divided by the price to book ratio for the S&P 500 as a whole. So what this tells you is when this ratio is above 1, it means that energy stocks are more expensive on a price to book ratio basis than the broader market. When it's less than 1, energy stocks are trading a discounted valuation. Historically, for most of this period on your chart, which is again a little over 20 years, energy stocks have traded at somewhat of a discount to the S&P 500. Back in 1998, 1999, as I said, a period I think very much like today, where energy stocks were just totally out of favor. You may remember, and I'll show you actually in a slide a little later on, a very famous Economist cover, Drowning in Oil, it said. They came out in March of 1999, basically saying there was a permanent oversupply of crude oil. Energy stocks extraordinarily out of favor, trading at about a 70, at about 0.7 on this basis, so about a 30% discount to the S&P 500. At the peak in 08, up to about 125%, so a premium to the S&P 500. Today, again, a record low relative valuation, down around 45%, so almost a 60% discount, a 55 to 60% discount in valuations to the S&P 500. Over the long haul, energy stocks and oil prices will tend to follow one another. The black bars you see on your screen, that is the S&P 500 Energy Index, and that, I guess, orange, goldish orange line is actually just West Texas Intermediate crude oil prices. And I took this back to 2014 because this is the period when oil saw its bear market over the last little over 5 years now. So in 2014, you can see in the summer of 2014, oil trading over $100 a barrel, WTI anyway, plummeted all the way to $26 and change in early 2016. And as you can see, energy stocks, which is this black line, also came down sharply over that same time period. So these two lines tend to track one another over time up until last year. Now, last year, we saw a significant recovery in oil prices off their late 2018 lows. So a little over a year ago, oil was trading around $40, $42 a barrel. It's been as high as 65 or so in the spring of 2019. We're in the low 60s right now. Yet energy stocks, especially since March and April of last year, have fallen, even though oil prices have stayed steady and begun to march higher more recently. Historically, these two things are highly correlated. In other words, energy stocks will ultimately follow the path of oil prices in the long run. There are periods of divergence, and the reason there are periods of divergence is that one of the things I love about commodity markets is that with physical commodities like oil, ultimately the value of oil is driven by supply and demand. If the price of oil is too high, then you will see a supply and demand impact very quickly. And that impact would be if the price is higher than it should be, then you will see excess supply because producers will go out and try to produce more oil, and you'll see demand destruction, and that'll tend to bring the price of oil back down. On the flip side, if oil prices are too low, fundamentally too low, then you're going to see faster demand growth, and you're going to tend to see lower supply cutbacks, which will tend to support the price of oil. So oil, in the very short term, obviously speculative flows can have an effect. We'll talk a little bit about that a little later on. But over the intermediate to longer term, oil prices are going to follow supply and demand. And that's what I'm going to focus on right now. Back in 2014, I think we were among the first analysts I know of in Energy and Income Advisor to tell our readers to sell out of energy stocks. Oil was going a lot lower. We predicted in late 2014 that it would get under $30 a barrel. Obviously, it did so in early 2016. At that time, that was not a popular call because energy was very popular, and we were telling readers to sell stocks like Seadrill, and that wasn't a popular call. Turned out to be the correct call. The reason we made that call is that, as I'll show you in a minute, the supply-demand dynamics were shifting in favor of lower oil prices. Today, I think that the general consensus is not particularly bullish on oil. The Wall Street consensus is that oil will average somewhere in the mid-50s in 2020. We think it's going to be 60 plus sort of range. And it's for the same reasons. The supply and demand dynamics are shifting again. And just like in 2014, the consensus isn't seeing it yet, but we think they're beginning to. And that's why you start to see oil prices rally since early October or so. So the problem with the stock market, of course, not a problem, but the situation with the stock market is, unlike commodities, stocks are much more based on sentiment. Valuations are much more based on sentiment. So when a sector is out of favor, it can stay out of favor for even when the fundamentals turn, at least in the short to intermediate term. Longer term, though, eventually earnings, cash flows, dividends, right? Stock buybacks, paying down debt, all of these moves eventually will out in the market. And we think that's what you're going to see here in the first half of 2020. Oil prices have already begun to move. Sentiment on energy is still weak, but as these companies start to generate, as I'll show you, a real wall of cash flow this year, we think that you're going to see a big surge in energy stocks. The sentiment's going to shift, and that's why we think this is such a compelling opportunity. I would say this is the best opportunity I've seen in energy since 2009. So let's move on and talk about it, talk a little bit more about oil. As I mentioned earlier, The sentiment on oil, the crowd's view, if you will, the consensus, the groupthink, if you will, is slow to adjust at turning points for oil. Back in the late 90s, you saw things like this famous cover from The Economist, drowning in oil in March 1999. I show you with an arrow here on the chart of oil on the right here. Oil was trading well under 20 bucks a barrel at the time, and The Economist was saying there was just way too much supply of oil out there. There was no way the glut was ever going to be absorbed, and they were predicting that prices could go down as low as $5 a barrel. Of course, the sentiment at the time was very bearish. I'm not just picking on The Economist. All over Wall Street, the sentiment on energy stocks was really bearish at that time. I remember it well, looking at energy stocks back in 1999, 2000, 2001, and nobody cared. Energy stocks were a minor part of the S&P 500. A lot of people shared the consensus view that there was a permanent glut or near permanent glut of oil at that time. But of course, that turned out to be pretty much the exact bottom for oil. The exact bottom for oil was actually December of 1998. But you can see when that Economist cover came out in March of 1999, if you bought oil, you were pretty happy, 9 or 10 years later, when it had gone up roughly tenfold to $150 a barrel. Sentiment took a while to adjust because what the economists and other Wall Street prognosticators didn't see in the late 90s was that you had a surge of demand coming from your emerging markets. China was reaching that phase of its development where energy demand per capita grows exponentially. Every country's been through it. China started to hit that in the 1999, 1998 through 2001 period. And eventually that caused a big supercycle higher in oil. But the crowd was very, very slow to adjust to that. On the flip side, of course, at the peak in 2014, we had this long period between 2010, 2011 to 2014, let's call it about a 3-year period, where the price of oil basically ranged, on the chart here on your right is West Texas Intermediate, between about $80 a barrel on the downside and sort of $110 to $115 a barrel on the upside. So oil, though there was some volatility, as you can see here, was pretty steady around $100 a barrel. Now, the reason that it was steady around $100 a barrel is that OPEC, and in particular Saudi Arabia, were maintaining oil prices around $100 a barrel. Every time you saw oil prices sell off because the market got worried about too much supply, Saudi Arabia was quietly cutting production to shore up the market and push prices back up. And they did that for years here. But if you look here on the left-hand side, what we were worried about in 2014, why we recommended selling oil and a lot of energy stocks back then, was the supply side of the equation. This is a chart of U.S. oil production from 2009 all the way up through the end of 2014. And you can see that in 2011, in the middle of 2011, U.S. oil production was right around 5.5 million barrels a day. By the end of 2014, we were at about 9.6 million barrels of oil a day. So you saw a 4 million barrel a day increase in U.S. oil production over the space of basically 3 years. So again, there was a surge in U.S. oil production from primarily, as you might have guessed, shale, right? So all these new technologies that we've developed in the last 10 years, I think a lot of investors forget that shale is a relatively new phenomenon. I can remember vividly going to conferences back in 2005, 2006, and everybody was talking about how global oil production was near a peak and was going to start falling, and that was going to push prices up to $250 a barrel. A lot of talk of that like that back then. But all these new technologies we've developed, fracturing, longer horizontal wells, better design of wells, allowed U.S. oil producers to ramp up production tremendously over this time period. At the same time, the Saudis were basically paying for it, right? Because what they were doing is every time U.S. oil production rose, that was causing the global oil market to become oversupplied, right? And that put downward pressure on oil prices. And we saw that in 2011 and 2012 and 2013 as well. And the Saudis and OPEC, but the OPEC led by the Saudis, I should say, was cutting production to push back the price of oil back up. So that was basically underwriting this growth in U.S. oil production because they were maintaining prices around $100 a barrel, at which point the U.S. oil producers could profitably produce barrels, and so they were out there drilling like mad. What we saw in 2014, the market expected for most of 2014 for the Saudis to continue with that policy. But we began to hear talk from the Saudis, from some of the energy companies, that the Saudis weren't they weren't real happy about paying for the U.S. shale boom by artificially propping up the price of oil and allowing these U.S. shale producers to continually produce more. In particular, I can remember in the summer of 2014, the Saudis were talking about how their exports to the U.S. were falling so rapidly because of the growth in U.S. oil production, and that was a big concern to them because the U.S. throughout history has been the largest export market for Saudi Arabia. So it caught the market by surprise, but you could see it in the data. You could see it in what the Saudis were actually saying, that they were no longer willing to prop up the price of oil. They were concerned about the unrestrained growth in U.S. shale production, and they were going to allow the price of oil to fall to try to squeeze the shale producers out of the market a little bit. And that's exactly what they did, and you can see the effect of that in 2014. Again, the crowd took a long time to adjust to this new reality. If you remember, if you were involved in energy markets, in late 2014, first half of 2015, a lot of analysts were out there saying, this dip in oil and energy stocks is a buying opportunity. Surely the Saudis aren't going to continue this market share policy, but of course they did. And as we expected them to, because their goal was to push down the price of oil. They couldn't afford those high oil prices anymore. So the crowd was wrong again in 2014, and it has been a very painful adjustment. We believe that the crowd is now 5 years later wrong once again at this turning point. The key shift underway is in supply and in U.S. shale production. I mentioned a little earlier on that I showed you that chart, the last chart of U.S. shale production growth between 2011 and 2014, very rapid. Even after the 2014 price collapse, shale producers in the United States were very much still in a growth at any price, growth at any cost mindset. And what I mean by that is that pretty much as far back as I can remember, up until very recently, energy producers, oil producers were valued by Wall Street based upon their ability to grow barrels of oil production. If you went back to 2012, 2013, and you put up a chart of the major U.S. oil producers, right? And you graph their stock performance in a given year by their growth in oil production over that same year, you would find a very close correlation between stock performance and growth in barrels of oil production. All Wall Street cared about was growth at any cost. They didn't care whether these companies were actually making money or generating free cash flow. They were willing to finance any drilling that these companies wanted to do. And so these companies are sensitive to that. The shale producers were in a growth at any cost mindset. And as I said, it continued long after the peak in oil. And what you can see here is the orange line is WTI oil prices. The black line is the U.S. oil-directed rig count, the number of rigs actively drilling for oil in the U.S. And you can see that when the price of oil was weak, like in 2015 and early 2016, the U.S. shale producers responded by cutting their rig count. So in other words, they were laying off rigs and trying to cut costs, save money. They didn't want to produce as much oil, so they started cutting the number of rigs that were actively drilling. But as soon as the price of oil rebounded, as it did in the last 9 months or so of 2016 and into early 2017, you can see the rig count soared. So oil bottomed out in February of 2016 and jumped until May of 2016. And with a slight lag, U.S. oil producers began to put rigs back to work in May of 2016. You can see when oil prices dipped in 2017, we saw a flattening in the rig count. When they started to rise again from mid-2017 up until the summer of 2018, sure enough, the rig count started to rise again. And when oil prices collapsed late in 2018, we saw the rig count flatten out and begin to fall. Until very recently, and what I mean by very recently is last year. If you look at 2019, the price of oil rallied, right, from $42 in December all the way up to $65 a barrel in April. It pulled back a little over the summer, kind of traded sideways, and then started to rally again in October, November, December of last year. And yet the rig count continued to fall. So even when oil prices recovered to a level where most shale producers are profitable, solidly profitable, around 65 bucks a barrel, there was no real increase in the rig count. The rig count steadily declined. Even as the oil prices started to rally towards the end of last year, there's actually a downside acceleration in the rig count. What the market is missing, if you will, what the crowd is getting wrong at this turning point is that shale producers have changed their strategy. We're no longer in that growth at any cost mindset. The reason we're not in that growth at any cost mindset is twofold. First, Wall Street isn't valuing companies based solely on oil production growth anymore. What investors are looking for, what Wall Street's looking for, if you will, is profitable growth. They don't want to see companies growing their oil production by 30% and generating no free cash flow. 5-6 years ago, that would have actually made your stock go up. But today, that no longer works. And if you aren't showing profitable growth, then you aren't going to get a premium valuation in the market. And so what we've seen over the last year or so is the shale producers' response to that desire from investors has been to set their capital spending at a level, a drilling activity level, if you will, at which they can make money, positive free cash flow with oil around $50 a barrel. Some of them it's a little bit lower than that, some of them it's a little above that, but right around 50 bucks a barrel is a good range, if you will, break-even range in terms of free cash flow for your major U.S. shale producers. The idea being that even at moderate to low oil prices, they're not going to have to go out and borrow money to fund their drilling activity. They can cover their capital spending plans. But what they've also done is they said, when oil prices go to $60 or $65 a barrel, they're not increasing their spending. As you can see here, the rig count's been steadily declining. Instead, they're just allowing that windfall of commodity prices, if you will, to drop to the bottom line in the form of higher free cash flow. So what you're seeing is a shift in growth at any price to profitable growth, free cash flow market. And therefore, the unrestrained growth in shale production that Saudi Arabia was worried about 5 years ago is no longer as big a concern for them. Saudi Arabia knows that if they orchestrate a rise in oil prices to $65 or $70 a barrel, you're not going to see a response out of the shale producers because the shale producers are 100% focused on generating free cash flow now, not on growth. So this is a big shift. A lot of people will tell you that the Saudi strategy of driving down oil prices in 2014 and 2015 to prop up the price, to squeeze the shale producers, if you will, failed. It didn't fail. It just took time for markets to adjust. When commodity markets are exposed to a shock, it takes time for that shock to cause shifts in supply demand dynamics. It took 5 years. Took longer than many people thought, including the Saudis, but it did work. We have seen a shift in the way shale producers think about the market and respond to commodity prices. And you can see it right here on the chart. Even though oil prices are in the higher end of their, say, 16, 17-month range, the rig count continues to fall. So if we move on here to the next slide, you may have heard of the concept of drilled uncompleted wells, or we call them DUCs. DUCs are simply Oil producers, U.S. oil producers in shale, for example, they will drill a well, but they don't put that well into production immediately. There are a number of reasons why they wouldn't want to do that. One of them is that shale oil wells tend to produce a big gush of oil when you first put them into production. And then production rate declines very sharply in the first year or so, actually in the first 90 days. But in the first year, in some cases, shale well output can be down 70, 80%, depending upon the play and the quality of the field. So, if oil prices are low, you don't want to put a well into production because you're going to get this big rush of oil and sell it at a low price. So what we've seen a lot over the last several years is that U.S. oil producers have been basically storing oil in the form of DUCs. So instead of putting these wells into production, they've simply capped them and decided that they would put them into production at a later time. That all changed last year. As you can see, this is the number of DUCs, the change in the U.S. inventory of drilled uncompleted wells each month going back to 2017. You can see that virtually every month they were adding to their inventory of DUCs. However, if you look here, sort of around the spring and summer of 2019, we only have data up through October. They've been drawing down their inventory of DUCs. And the reason is that they're completing those wells because that's a cheap way for them to grow and for them to maintain their production. Instead of drilling a new well, it's much less expensive to complete those DUCs. But as you can see, the inventory of DUCs is now falling at a rate of more than 200 DUCs per month nationwide. So the entire inventory of DUCs, the excess inventory of DUCs, will be exhausted at this rate by sometime in the middle of 2020, maybe into the third quarter of 2020. And what that means is that you're going to see an even more profound response in U.S. oil production. One of the bearish arguments for oil, if you will, is that even though the rig count has come down, the amount of oil being produced in the U.S. is remaining relatively high. It's not growing. It's not growing a lot as much as it was a couple of years ago, but it's still showing some year-over-year growth. That's going to change as these DUCs are completed. The reason the rig count's falling, but oil production is holding up, is because producers are completing those old wells, if you will. As that inventory of excess of DUCs declines, that avenue of growth will no longer be there. It will be exhausted, and I believe you're going to see a significant drop in U.S. oil production growth in 2020. A couple years ago, growing at 1.5 plus million barrels every day. This year, I think you're looking at more like 400,000. And in 2021, I think you could see flat to up just 250,000 barrels. That is a major shift considering that slide I showed you a little while ago where, U.S. oil production grew by 4 million barrels in 3 years, 4 million barrels a day in 3 years, back in 2011 to 2014. It grew even as oil prices fell in 2014 to 2018. And we're only now just seeing the effect of the new policy of shale producers to focus on free cash flow, the completion of these DUCs, and the declining rig count I showed you here having an effect on U.S. oil production. As the market begins to recognize that shift more and more, we're already seeing it in oil prices, I believe. I think that's a major reason why you've seen oil prices recover from the low 50s back in early October to around 61 bucks a barrel right now. But I think you're going to see it start to show up more and more in the stocks as well. In fact, just over the last few days, really, we started to see energy stocks really perk up. And I think that may be the very beginning of the run. I mentioned that the U.S. oil producers are focused on free cash flow over growth. And I think this slide really sums up that shift well. All I did here is I looked at a selection of some of the largest U.S. independent shale oil producers in the U.S. Anadarko, which is now part of Occidental, EOG, Marathon Oil, Noble, Hess, Pioneer Drilling, Continental Resources, Devon, Apache, Concho, and Diamondback. And what this chart shows is from 2015 to 2018 historic data, and then from 2019 through 2021 projections from the consensus on Wall Street. This is free cash flow estimates for each of these companies. And you can see in 2015 that these companies were negative, produced negative free cash flow of $23 billion between them. So even though oil prices were coming down, these companies were spending like crazy and borrowing money to fund their spending. They were spending way more than they were generating in cash flow. Their capital expenditures were not being cut aggressively, even though oil prices were coming down. And they were basically a wall of red ink. 2016, same story, right? Virtually all of these companies produced negative free cash flow to the tune of $7 billion. If you look at 2017, even though oil prices rallied from their lows, right, in early 2016, you still saw virtually all these producers producing negative free cash flow. In 2018, even though for most of the year, for the first 9 months of the year, oil prices were rallying, got up all the way over $70 a barrel WTI, still only half the producers produced any kind of positive free cash flow. Now in 2019, oil prices fell relative to 2018, yet you can see almost the opposite effect, right? Almost all the producers were producing positive free cash flow. This year, you're looking at these companies producing an estimated 12 billion or so in free cash flow. And in 2021, it's going to approach 15 billion in free cash flow. So this is a major shift. And it's all because of the shift from focus on growth at any price to focus on free cash flow. And it is having a major effect on global oil supply. One more thing I wanted to address on oil before we move on is something that it gets a lot of attention in the mainstream media, and it generates a lot of hype. And so I think a lot of investors are overly concerned about this issue. And that is the idea that global oil demand is going to peak and decline because we're going to shift away from using oil towards using electric cars. So there are many reasons why I think that impact is overblown and that global oil demand is going to continue to grow for the foreseeable future, and that we're nowhere near a peak in global oil demand. But I just wanted to give you an example, which is kind of a time machine, if you will. And that's Norway, believe it or not. Norway has, of countries of any size anyway, the highest penetration of battery electric vehicles. So these are full electric cars. Also hybrid cars and plug-in hybrid cars. At the end of 2018, so this chart was from 2018, you can see that battery electric vehicles accounted for about half, almost half of Norwegian car sales. Plug-in hybrids accounted for another 15% or so, and hybrids accounted for another 11.2%. So your conventional diesel and gasoline engined cars, in terms of new car sales in Norway, we're only about 28% of the market. So this is much higher penetration than in any other European country or the US, of course, where electric cars are just a very small part, a couple percentage points of the market at best. But what you can see here, and so you might say, okay, well, Norway, surely, with all these electric cars on the road, a very aggressive carrot and stick approach towards promoting electric car demand, right? They heavily tax gasoline and diesel cars. Battery electric vehicles are exempt from many of those taxes. It makes them appear cheaper. To give you an idea, a simple Golf, Volkswagen Golf vehicle, a gasoline engine car, because of all the taxes, can cost $35,000 or $40,000 in Norway. US, it would be low 20s or so. But the battery electric vehicles are made of that same car, that Volkswagen Golf, are made to be cheaper because they're exempt from many of those taxes. In addition, you get things like free tolls on highways in Norway, which are very expensive, free parking in city centers, which is very hard to get. So they heavily subsidize electric car demand. However, the problem is that while many people are buying electric cars, Most of them, something like 80%, also still own a gasoline or diesel vehicle. So what they're doing is they're using the electric car to commute to work so they can park easily and be exempt from tolls. And they're using the, their traditional gasoline or diesel car, to drive to the fjord, or I guess, on the weekend, right? So what you see here is that between 2015 and 2017, even though electric car market penetration grew from less than 20% in 2015 to around 45% by 2018, diesel and gasoline cars still account for the vast majority of all miles driven on Norwegian roads. Despite the fact that electric car sales are up, most people still do most of their driving with diesel or gasoline engines. And this is a chart of Norwegian oil demand. So I showed you that big increase in penetration for electric vehicles, but Norwegian oil demand at an all-time high. So my point is that don't expect electric vehicles to have a major impact on, you in the United States and Europe, you're not going to see penetration rates of 50% as you do in Norway today, probably not for 20 years plus. And even when that does happen, that doesn't necessarily mean that oil demand is going to decline meaningfully, if at all. And I think Norway is a pretty good example of that. I want to give you a couple of names. In particular, I want to give you a name to buy and a name to sell. So the name that we like is Concho Resources. Symbol there is CXO, New York Stock Exchange. They're a Permian Basin producer. Now, if you can see, look here on this map. This is a map of West Texas and eastern New Mexico. And what you can see is that the Permian Basin really has two halves. You have the Midland Basin on the east, and you have the Delaware Basin on the west. And so the Delaware Basin is part of Texas and also a big chunk in New Mexico as well. The Midland Basin is all in Texas, okay? So Concho, though, has acreage in both of these plays, both the Delaware Basin and the Midland Basin of the Permian. Now, here's a chart of the stock price of Concho Resources. They were also one of the largest producers in the Permian. And here's a chart of the stock price. And you can see that in 2015, 2016, 2017, and through much of 2018, the stock actually kind of was drifting higher. So even though oil prices were volatile, you saw some big dips in Concho, the stock performed quite well until last year, really, late 2018 and through 2019, when it really plummeted from highs around $160 a share, if you will, to lows around 62 bucks a share in August. Now, the big reason for this last drop in Concho last summer, and it has recovered since, by the way, it's up in the 80s now. But the reason for this big drop is something you may have heard of on the news. It's called parent-child well interference. So imagine you have a square mile of land in the Permian Basin, and you're going to drill horizontal wells, which you're going to fracture, right, to produce oil. And if you put too many wells on that parcel of land, then production from one well is going to have an influence on the pressure in neighboring wells. So your first well, the parent well, is going to interfere with the production from other wells. So if you pack the wells too close together, right, put too many wells on one piece of property, and you fracture all these wells, then the fractures from one well are going to connect with fractures from neighboring wells and impair production from those neighboring child wells. This is called well interference. By the same token, if you space wells too far apart, then you're not going to drain that basin as effectively as you could otherwise. You're leaving barrels in the ground. You're leaving money on the table, value in the ground. So it's a balancing act. You have to kind of figure out, and some of it's through simple, good old-fashioned trial and error. You can sit there and go through reams of data if you like, but at the end of the day, a lot of it is still trial and error, right? To see how many wells you can effectively put in a particular part of your acreage without impacting production too much, okay? So Concho last year, in the first half of 2019, drilled a well called the Dominator well. And the Dominator well, which you can see on this chart, was a test of spacing. And it was putting the wells much closer together than any of the other wells they'd ever drilled in this company. So you can see this chart here on the left. All these dots represent wells that they drilled in projects that they did in each of these years, 2018, first half of 2019, and the second half of 2019. And the vertical axis, the lower you are on the vertical axis, the closer the wells are together. And on the horizontal axis, the further right you go, the more wells you're packing onto a particular parcel of land. And you can see the Dominator way out here on the lower right-hand side of the chart. This is the tightest spacing, the most number of wells in a given section of land that they'd ever tried. Well, the Dominator well failed. There was terrible interference issues. It forced Concho to cut their production guidance for 2019, and the stock plummeted in August as a result of that. But there was a knee-jerk negative reaction to that because, obviously they're not going to be able to drill as many wells as they did at Dominator on their land. But the reality is that failed wells like that are very much a part of the oil business. And what that taught them is that they can't space wells that close together. They can't pack that many wells on that parcel of land. So what they did is they just retooled their project development for 2020 to focus on wells that are farther apart. Even with wells of 6 or 8 wells per section, as opposed to 18 plus in Dominator, they have many decades of inventory on their acreage that they can focus on. And you can see that all they've done is retooled their development plan. So what we've begun to see is that they've said that even with this Dominator failure, given their new development plan, Concho Resources produces positive free cash flow above $50 a barrel. When you get up to about $55 a barrel WTI, you're looking at very solid free cash flow generation. At 60, they're going to produce upwards of $750 million in free cash flow in 2020. At 55, they produce around $350. So between $55 a barrel WTI and $60 a barrel WTI, their free cash flow actually doubles from $350 million a year to a run rate of about $750 million a year. Even with their new development plan with the wells spaced farther apart, so you don't get that interference problem. For a company of the size of Concho, with a market cap sort of around $17 billion, that's a very solid level of free cash flow generation. The stock is still very cheap. On the basis we look at, and I look at a number of different valuation metrics, but we don't need to see, the important thing to remember is we don't need to see $70, $80, $90 a barrel oil for Concho to work as an investment. All we need to see is for oil to hold above that $50 to $55 a barrel level. And if we average around $60 a barrel, Concho is going to deliver very significant free cash flow between $750 million in a year up to about $1 billion in a year. They're going to use that cash flow to pay down debt, buy back stock, and continue to pay a dividend. They just initiated a dividend for the first time in their history last year. I do think they'll probably raise it over time. And all we need for that to happen is for oil prices to remain supported around 50 to 55 and preferably around 55 to 60. That's all we need for them to happen is for oil prices to remain moderately high. Not calling for, $100 oil again anytime soon. All we're calling for is oil prices to average above $60 a barrel this year. And at that price, Concho is going to deliver a real wall of free cash flow this year. So that's the name that we like. The valuation metrics we look at, things like price to book and also enterprise value to EBITDA. Even if Concho just returns to the valuations it earned in 2017, 2018, before that mainly Dominator-led plunge in the stock, then it could be a double in 12 to 18 months. Now, I know that sounds aggressive. I hate all these promotions you see people talking about 100% returns on stocks, but to me, it's actually pretty conservative. Concho trading around $85, $86 a share. If oil prices remain around 60 and they generate the kind of free cash flow I'm talking about, you could easily, just with a return to valuations from 2017, 2018, not 2013, 2014 peak valuations, but those sort of mid-cycle valuations, you're looking at a double in the price of Concho from current prices. Not all shale producers look good to us at the current time. One name we do not like is Apache. Apache, symbol APA, we have it as a sell. Apache, like Concho, is a Permian Basin producer. They have acreage everywhere you see gold here. The Midland Basin, the Central Basin platform, which is kind of the middle of the Permian, and they also have some in the Delaware Basin. But the focus of much of Apache's development over the next few years is this Alpine High play. Now you can see the Alpine High play here on the western edge of the Permian Basin on the map on the right here. Now the Alpine High play shows a lot of growth in production, but most of that production is natural gas, not oil. We are not bullish on natural gas. We've been bearish on natural gas I can't remember the last time we were bullish on natural gas prices, other than occasionally you'll see a pop in gas in the winter months, but we've been consistently bearish on gas for more than 5 years now. Alpine High is primarily a gassy play. Most of Apache's growth is going to be on the gas side, not oil. And we think that the amount of gas they produce as a percentage of their total production is actually going to rise over the next couple of years. We would rather own a company like Concho that is more focused on oil development and liquids over natural gas. So that's my little take on oil, energy stocks, valuations there. I think it's a tremendous opportunity. I'm going to turn the floor over to my friend and colleague, Roger Conrad, talk about some of the income side of our Energy and Income Advisor service. In addition, just a little quick housekeeping note for those of you who may have arrived late. This session is being recorded. We will have a copy of the recording to you probably tomorrow morning. We will have a copy of the slides to you as well. In addition, we are opening up the floor to Q&A after the conclusion of our prepared remarks. You can ask a question at any time you like by typing the Q&A box on your screen or the chat box on your screen. Type your question. At the end of the prepared remarks, we'll read the questions and provide answers. So I'm going to turn the floor over now to Roger.
Thanks, Elliot. And once again, just thanks to everyone for joining us today for this presentation. I hope everybody had a happy new year. And we're very excited, as you can probably gather from what Elliot said about 2020 in this sector, which it's been kind of a long, tough road, perhaps the past few years, but that tends to sow the seeds for good things to come. So I'm going to talk mostly here on the income side, as Elliot indicated, the income side of Energy and Income Advisor. And my focus is going to be mainly on midstream energy companies for you today, including many of the MLPs, which have been one of the hardest hit groups of the sector. To a lesser extent on outlook for super majors, which we think are super attractive at this time, particularly for the most conservative investors out there. When most people think of the midstream business, they think of oil and natural gas pipelines, and that certainly continues to be a big part of it and a big part of our focus. But midstream also includes the gathering pipes that connect directly to oil and natural gas wells, processing facilities, that separate out gas liquids like ethane, propane from the dry gas, storage tanks, storage caverns, basically every means of transportation for energy and byproducts, from pipelines to trucks and rails. So pretty much everything between upstream, which is actual wells, to downstream, which is refining, along with fuel and energy distribution. Midstream touches and connects literally everything in the oil and gas business. Customers include industry players from super majors like ExxonMobil and major refiners like Valero Energy to the wildcat producers, which is where a lot of the risk lies right now, and even regulated utilities, which are probably the safest customers that these midstream companies have. So midstream gas business traditionally has generated a lot of cash from reliable fees. That's still very much true today. Companies have historically paid it out generously to shareholders as dividend distributions. It's also still the case today. But it's a business right now that I think perhaps the understatement of the last few years is that it's going through an historic stress test, and which arguably hit a low point in late November of last year. So here's the opportunity in midstream companies right now. First and foremost is the high yield. For example, the S&P 500 index fund right now will yield about 1.8% in income if you hold it for a year. 10-year treasury bonds pay about 1.9%, again, a fixed rate. A high net worth savings account may get you 2%. Even the best in class utility stock, which most of you know, it's one of my favorite sectors for long-term investing for growth and income, that's now paying on the order of 3% and even less. And that's after an historic up year, which pretty much is the mirror image of what we've seen in many of the midstream high yielding companies. So in the contrast with midstream energy companies, because of that, again, literally a 5-year bear market for the sector, really couldn't be greater than it is right now. You even look at companies like Enterprise Products Partners, which is one of our longtime recommendations at EIA. It yields more than 6% right now, and that's a dividend they raise every quarter. ONEOK, another midstream company with a great record, still paying around 5% despite a pretty explosive return last year. And if you look at the Alerian MLP Infrastructure Index, which is basically the biggest midstream companies in the country, organized as MLPs, they collectively yield now better than 9%. So you're not going to really find anything out there better for income in this market. Second, and probably even more important, the best in midstream companies have been hardening themselves against downturns now for well over 5 years. You heard Elliot talk a lot about the energy business really kind of adapting to that lower for longer energy price environment that we first started talking about back in early 2014. Just companies having to really adjust themselves, cutting loose riskier operations, cutting loose riskier customers. For example, building customer relationships with more creditworthy entities rather than those wildcatters, which have been so squeezed by what we're seeing in the shale business right now. Focusing on the higher percentage areas of the business, meaning the stronger shale basins and so on. Consolidating, we haven't seen a whole lot of that in a positive way, but I do think that we'll continue to see more of that. There are just too many shale companies out there right now in the midstream business, particularly if you compare that to Canada, with has far fewer companies. And then above all, I think slashing debt, probably the most important thing that you see companies doing in a very big way. And it's a huge contrast, again, with what was going on in 2015, 2016. Sometimes righting the ship has required cutting deeply into dividend distributions, which has punished companies' share prices even more in a reputational way, which I'll talk a little bit more about in a minute. But the result is that these distributions, which are represented by this 9% average yield on the Alerian, are actually far safer than they've been at any point since oil prices first broke under $100. And this is very quantifiable by coverage ratios and so on. In fact, a growing number of midstreams are now self-funding capital spending projects, which means the only time they're having to access capital markets, which are arguably very hostile at this point, is to refinance whatever debt they're not paying off in advance. And we've even seen a number of companies really push those debt maturities out. So refinancing risk, immediate refinancing risk, is not the risk it was just a few years ago. It's absolutely true, though, the North American midstream business is now facing a stress test, as I said before, of historic proportions. And for share prices to recover, companies are going to have to prove themselves resilient. But there's every reason to believe our favorites are going to do that in the next several quarters. And when they do, that's when we expect to see capital gains of a magnitude that I think will dwarf even what we see with those big yields right now. The key is how fast midstream recovers, and what happens to the dividends is how they deal with the stress test, which is basically this. How well prepared are midstream companies for the lower shale volumes that will result the next several quarters as North American shale producers cut back on capital spending? So you've been looking at this first slide for a bit. One reason I've left it up this long is there's a lot to take in. But the main point I want to make from this is that just as U.S. shale basins are so far-flung and diverse, as you can see on this map, so is the impact of the midstream stress test on individual companies. Extreme variation on the impact of impact on individual companies, just as there is this wide geographic diversity. For example, activity in places like the Barnett Shale, if you look at it on the map in North Texas, has been dropping for some time. Midstream companies operating there have seen contracts with producers expire and be renegotiated at lower rates, if at all. Meanwhile, the nearby Permian Basin has seen record activity. A shortage of pipeline capacity, to give you another example, coming out of Appalachia for natural gas has held prices at some hubs there 25% more and below the Henry Hub benchmark along the Gulf Coast. And that's triggered a very painful adjustment for producers and even larger midstream companies like EQM Midstream, even as companies like Kinder Morgan are bringing massive and fully contracted new natural gas shipping capacity on stream in Texas. So that's enough of that slide. Let's move to the next one, which is going to show another piece of the midstream challenge right now, the midstream stress test, and that's state regulation. The Trump administration was very slow out of the gate, filling out the 5-member Federal Energy Regulatory Commission at the start of its term back in 2017. And the lack of a quorum brought, as a result, pipeline approvals basically to a standstill in early 2017. Since then, FERC and other agencies have aggressively pushed practically any application that crosses their desk. And this spring, that will include the Justice Department defending the Atlantic Coast Pipeline at the U.S. Supreme Court in a very significant case there. But the Trump administration's zeal has been at least matched by that of pipeline opponents who've seen record fundraising and as a result are basically able to challenge any midstream project in the courts anywhere they wish. And they've enjoyed increased success in the states as well, as this map here shows. It's basically showing shale drilling regulation. If you look at the key there, the dark blue states are where hydraulic fracturing, otherwise sometimes known as fracking, is absolutely banned. The light blue shows where it's allowed, but with some restrictions. The orange states are probably the most worrisome. That's where state governments are debating and acting tough regulations, and in some cases they have. And then, of course, the white is more of a traditional traditional regulation, places like Texas, where they're still very lightly regulated and still very encouraging to the sectors. Of the states in orange, I think, Colorado has at least so far resisted some of the more restrictive proposals we've seen. It's also worth pointing out from this map that some of the states where the opposition is the fiercest, where they've banned it outright, states like New York, really haven't been significant producers in any case. New York could be a producer, of course, but it has not been significant to the overall picture, and therefore it's not significant to that many companies in the business. I really do think that the industry blew it by allowing hydraulic fracturing to be nicknamed fracking for obvious reasons. But the real irony is here that in stark contrast to the 8 years of the Obama administration, when pipeline approvals pretty much sailed through unless they were named Keystone XL, it's become routine for pipelines to be delayed and in many cases even to death. We've seen a number of projects, companies just walk away from them. Other companies say, we're done with this business. And even those that do wind up getting built, they tend to be far more expensive than the developers initially planned for. So that's a big part of the stress test. It does arguably increase the value of existing pipeline infrastructure, which is the subject of our next slide, also a map. And you can see, as we move to that next slide, that a lot of it is concentrated. And that's kind of a legacy of previous stages of development, even predating shale. A lot of pipelines on the Gulf Coast of the US and Texas. And this does remain, all else equal, the safest place for companies to operate on a regulatory basis. But the bigger point here is regulation has become a major barrier to entry in this business, and it takes a big and strong company to overcome the many potential hurdles to a major project. Only these barriers are only going to become steeper in coming years, so companies are going to have to get bigger and stronger, and that's just on the state level, forgetting about what might happen on the federal level as these states tighten regulation on both drilling and greenhouse gas emissions, including from pipelines such as methane, that the federal government has actually relaxed regulation on. Here is proposed relaxing regulation, but companies are going full on dealing with, and again, to try to reduce these leaks and so on. So anyway, so here's the essence of the midstream stress test, and the main points I've outlined here on the next slide. First, reduced capital spending on oil and gas drilling means fewer rigs deployed. That means less output and less throughput on midstream systems. Fairly axiomatic there. Second, the impact of reduced producer CapEx on midstream company cash flows, though, is not one-to-one. As I pointed out, economics of different shale basins vary widely, and the economics also vary within the individual basins as well. Midstream companies more central to the richest areas may continue to see rising throughput, even as more peripheral rivals experience a crash. Nothing complicated there, just simple economics, but again, another reason why we really have to differentiate. And another reason, customer quality, and that probably matters even more. Shale producers have been finding ways to cut costs, some quite dramatically, as Elliot pointed out. And barring a further crash in oil and gas prices, the stronger companies are likely going to be able to maintain output. In fact, will probably grow it some in 2020, even as weaker companies cut to the bone. Stronger producers are also likely to be far more likely to renew expiring contracts on comparable terms with midstream companies, while weaker ones will try to chisel down fees to stay alive. So again, very, very important who you deal with as well as where you're working. We think scale will prove to be a critical factor here. Mainly the larger and more diversified midstream companies it's less likely that fortunes will rise or fall on the health of a single basin or company. So larger companies mean more resilience to what lies ahead. We can't really forecast at this time exactly what the output will be in every region in first half 2020, which is really the critical period for this midstream stress test I'm talking about. In the most recent issue of Energy and Income Advisor, I did put together a map highlighting the trend for oil and gas production by state from the beginning of the second quarter through the end of the third quarter of this past year. So there were some trends that were evident from that. And even then, we were seeing some flagging activity in some formerly prolific places and currently prolific places like Oklahoma and Pennsylvania that are very important to the national production. I suspect by the time all the data is available, we'll see other states where output was still growing over the test period start to taper off a bit in the fourth quarter and actually tip into the red perhaps next year. And again, the impact on the individual companies that operate within those states is going to vary widely, depending on where they are and who their customers are. But point here again, the stress test is ongoing, and each earnings season is going to essentially present a report card for the 70 or so midstream companies in our Energy and Income Advisor coverage universe. Our next slide highlights the worst hit segment of the North American midstream sector, and that's master limited partnerships, which have been hit by severe reputational damage nearly as much as by falling energy prices. And this graph tracks the Alerian MLP Infrastructure Index I referenced earlier in my part of the presentation. The left-hand side shows the index at its apex in early 2014. That was a time of record master limited partnership IPOs and when oil traded comfortably over $100 a barrel in the US. You might recall, longtime readers will recall, we panned pretty much all those IPOs that came out in that period of time. And for good reason, many of them were basically just packaged junk that has fallen apart. So But the time right now is about 180 degrees different from that. MLPs for a time resisted the drop in oil prices in the Alerian index. And this was, again, a reason why there were so many IPOs as well. The actual index didn't peak until January 2nd, 2015. And the reason is the sector had been sold to investors on the idea that because midstream companies were paid in fees, that earnings were not tied to energy prices. So for a time, money actually flowed into the midstream companies and MLPs from producers, as well as other companies where earnings were obviously linked to energy prices, such as service companies and drillers. The first real hit to midstream, and especially MLP's reputation, was when it became obvious their businesses were also negatively affected by falling energy prices, as the producers on the other side of many of their contracts came under growing financial pressure. The result was a hit to midstream system throughputs and cash flows, but more importantly, to their ability to raise capital. By the time the Alerian bottomed on February 11th, 2016, kind of in the middle of that picture there, the index value was roughly 60% below its high point about 13 months earlier. Oil has since then about doubled off the low, but after a solid rally later in 2016, the Alerian, as you can see on this graph, returned to the downside and is still less than half its old high. And the reason, as much as weak energy prices, weak gas and oil prices, is reputational damage to midstream in general and MLPs in particular. Simply speaking, after a 5-year bear market, income investors don't trust the high yields MLPs offer, nor do they trust the structure, which Wall Street is now pushing the remaining MLPs to abandon, either by consolidating or by converting to corporations. And even takeovers have come to be feared, as many buyers, including general partners, have struck with their offers following big declines. At the end of the day, I believe this reputational damage is probably the highest hurdle MLPs have to climb to recover to their old levels. And we continue to believe there are just too many midstream companies in the US, as I mentioned earlier, especially when you consider all the midstream assets that are also owned by private capital. So a lot of owners out there, really needs to be more consolidation. But there are companies now that are separating themselves from the pack as not just survivors, but as the leaders of an industry in recovery. And with investors basically pricing them as though they were business failures already, all they have to do to prove otherwise to be huge winners in 2020 will be simply to demonstrate their resilience. So how do we sort out these companies? And how do we tell if a 9% yield is safe? Let's take a look at our next slide, which shows how we're identifying the best from the rest. If you look down the table of our MLPs and midstream coverage universe that's on the EI website, you'll see the vast majority of them currently rate sells or holds. So stock selection has probably never been more important. And here's in brief how we're doing it. I would like to point out that one of our recommended MLPs this year returned better than 40%. In fact, our actively managed portfolio is 6. We have 7 recommended MLPs, and 6 of them actually gained ground this year. The other is down a little less than 9%, largely because of takeover fears we believe are overblown and will wash the other way in 2020. But in any case, that's a pretty steep contrast with that ugly chart of the Alerian MLP index that I just showed you. So we believe our system does work. I'm not going to go into too much detail on each of these criteria other than to say that there are multiple factors we consider for each one of them. I know a lot of advisors like to throw metrics at investors like coverage ratio, which is basically the inverse of the payout ratio, or the debt to EBITDA ratio, which is technically earnings before interest, taxes, depreciation, and amortization, but it's really just a way to measure cash flow. I don't have any problem with these metrics. In fact, we use them in our analysis pretty consistently. But if you just leave the analysis at that, you're not going to get any kind of warning, for example, if a company has an expiring contract that could severely contract that cash flow and thereby threaten the dividend. Conversely, and this is actually probably more important right now, you may miss out on a company or MLP with a very high and safe yield that just looks a lot riskier than it really is because of a one-time factor such as an asset sale, a restructuring move, or maybe they have an asset that's about to come online, they've been spending money on, now it's going to become a big earner for them. If you really want to get an accurate picture of what a company or MLP's strengths and weaknesses are, you got to look at all these factors together. At a strong company, they reinforce each other. At a weak one, they pull each other apart. I know a lot of people don't like the MLP structure because of K-1s and other accounting issues. I will say that most MLPs, in fact, all the ones we recommend, have abandoned those incentive distribution rights that no one had a problem with 5 years ago, but in this crunch now suddenly have become very toxic. And again, companies have listened. They've done away with these structures. In some cases, the parent or general partner has just simply taken stock. So now they're totally on the same page with other investors. But this is something that's really no longer a problem or a challenge for MLPs and MLP valuations, and particularly not the ones we recommend. I'll also say that Elliot and I have also rather liked the tax advantages of the MLP structure, the K-1s and so forth, notwithstanding. But then again, we live and breathe this stuff. I know a lot of investors just simply don't like complications. If you feel that way, the good news is a lot of the energy midstream universe that we cover right now and recommend is organized as corporations. So the MLP structure, if you don't like it, there's plenty of opportunity to invest. In fact, a lot of the biggest winners we had last year in our portfolio were in this category. We're midstream companies coming off lows, but are organized as corporations. Like I say, we recommend a growing number of them in the EIA actively managed portfolio, which is our core portfolio. We offer not only recommendations on stocks and where to buy them, but also how much to buy them in that portfolio. So it's a real portfolio, and that's how we measure our track record. One we recommended last year actually gave us a return of well over 50%. So again, there are other ways to go, though. Again, I would look for our MLPs to do far better in 2020. In fact, I think that's where a lot of the leverage is right now to a midstream recovery. So how do midstream companies shake out as we move into 2020? As I said earlier, if you want to get a comprehensive look at the whole sector, our MLP and midstream coverage universe, which we track on the EIA website, is going to be your best resource. We also have a coverage universe of international companies, Canadians and Australians. There's a lot of value in those areas as well. We have another coverage universe that looks at producers and service companies. So this is where we track everything that we put into our portfolios and so on. But that's where you would find information, again, on midstream in a very comprehensive way. But just to give you an idea of where some of the investor traps are, I wanted to show you a feature of Energy and Income Advisor we launched, I guess about 1.5 years ago. That's our endangered dividends list, and it's the next slide. I can tell you this list has saved EIA readers from a lot of pain since we introduced it. And while not every stock on this list is a sell right now, some have fallen so far that they basically reflect any future bad news short of an actual bankruptcy. Every one of these companies is a candidate to cut its dividends sometime in 2020. And the sell-rated companies are likely to tack on a sizable future capital loss, as well as the reduced income. So really adding insult to injury. Really stocks you want to avoid right now. Like I say, too many midstream companies out there. Not all the consolidation is going to be positive, and these are pretty good candidates to tack on more losses. The only other point that I want to make here is that this is from an older issue of EIA, and the most recent issue is even longer than this list. There's 20 companies on it, 15 are midstreams. We identify members of the EDL. We have 8 warning flags, which we enumerate and discuss for affected companies in every issue of EIA. Again, it's a regular feature that I really hope will identify many fewer names going forward as this industry gets stronger. But again, there's just too many owners of midstream assets right now. And I'll go so far as to say at least half of the midstream companies and MLPs that are out there right now aren't going to be around in 5 years in their current form. Those assets will be absorbed somehow by a larger player, potentially profitably. That's the best case, but also potentially not. There was a company called Sanchez Midstream that actually completely imploded last year as its parent filed bankruptcy. So that's definitely a possibility for some of the midstream companies out there. But not all the companies that you see now with the high yields are in danger. And again, like I said, I think this is where the real leverage is. And the next slide is going to highlight a feature that we have established to take advantage of that. It's called our high yield energy target list. We launched it in May 2019. As it turned out, our timing could hardly have been worse. Some of these total return numbers will indicate that. What was a retreat from midstream actually became a full-blown rout. So that did not help with any of these. Some of these have been winners, though, and overall our performance has pretty much mirrored that of the Alerian Midstream Index. Again, losses, which we didn't want to see. But I think the real thing for this, again, is that this is a way we hope to get leverage going forward. Some of these companies, and by the way, they're all midstreams, they are facing a pretty brutal stress test right now from the factors I've highlighted in the presentation, mainly the fact that producers are cutting back on CapEx. They're looking at a shortage of activity. They're looking at some problems with customers. Some of them are looking at debt burdens that have to be reduced. But so a pretty brutal stress test right now from the factors. And again, that's after all why they yield so much, and that's where the opportunity is. The addition of the slide, though, that I'm showing here, addition of this table in this slide, is from a previous issue of EIA. And since it went to press, we have seen a remarkable recovery for some of these stocks. In fact, the two biggest losers on this list here that you can see from the total return column, they're actually up about 70% and 50% respectively from their low point. So that's some pretty incredible leverage demonstrated there just in the past month. And I think it's very much indicative of some pretty powerful leverage to a future recovery. We put this list together as a way for more risk-tolerant investors to get big yields along with solid leverage to the recovery. So different from the portfolio where we do have a mix of things in there and kind of a more focus on risk and so forth. But this is, again, a list of companies that we think have a lot of leverage to recovery. Caveat, if any of them really do break down as businesses, we'll get rid of them. But despite the abysmal timing of launching this list, all these stocks are still paying their dividends, and actually most of them have increased their payouts at least once over this period, which again extending back to late May. Not a list for everyone, and again, as I pointed out here, midstream is in the middle of a stress test that's already weeding out many companies. So for those who value safety above all else, I would encourage checking out the midstream companies in the actively managed portfolio, or any of the MLPs and midstream companies that draw a conservative rating in our rating system in general. All these companies are aggressive, for the record, and we do rate all of our midstream companies on that basis, in that table on the EIA website. If you're looking, though, for something to ride a recovery in midstream to a sizable gain, this is a great place to look. My last slide is, in fact, the last slide in this presentation before we're going to turn the program over to your questions. So please type those into the Q&A box. I see a couple of you are using the chat box for that purpose. That's fine as well. We will address everything. But first, a little bit of a section. And if you're a little bit put off by some of the numbers you saw in the earlier slide, the high yield energy index, this is a group that you're going to want to take a look at if you're conservative, and if you're particularly conservative, you want to invest in energy, get that income. And this is a slide of Chevron, the U.S. super major. So I'm going to talk a little bit about the super majors now. The issue of EIA that posted December 28th, Elliot and I do present a pretty extended discussion of the super majors as an asset class and reasons we do like them. And I won't repeat everything that we said in there, but the main point is that this is a group that's already, during this cycle, which has been going on for about 5 years now. Been about 5.5 years actually since oil first cracked under $100. This is a group that has proven its business model is as solid as ever in this business cycle. This is an era where a lot of Wall Street firms in particular pressure companies to do one particular thing, become a pure play, because that makes it easier for street firms to put them into various indexes and to invest them in various cycles. But the super majors have resisted this over the years. And as a result, they combine right now global oil and natural gas production, downstream operations like refining and distribution, and increasingly even electricity and renewable energy. So a lot of different things that generate cash flow. Some of the other names in here: Chevron, also Eni, ExxonMobil, Royal Dutch, Total, BP. These are all in that group, and almost all of them right now are generating free cash flow after all capital spending, and increasingly many of them are doing that after paying their dividends. So after dividends, after paying all their capital spending, they still have enough money there to retire debt, to buy back stock, and so on. It's a very unique position in this business. And for many of them, it's the result of completing major long life projects in recent years. So doing so increases output at the same time that capital spending declines because the projects are finished. These are things like oil wells in the Gulf of Mexico. There are things like LNG production facilities in Australia. But as a result, we're seeing a lot of these companies increase production at the same time capital spending is dropping. That means rising free cash flow. And this is a trend that's going to continue over the next several years. Eventually, the supers are going to have to start investing heavily again in future production, but they're also the only group of energy stocks with an unblemished track record for surviving the worst disasters. So again, I think this should give people a lot of confidence. Eni, for example, routinely weathers production disruptions in countries like Libya, where it operates. BP, I think probably the biggest stress test in the last 10 years, certainly affecting a super oil, the Macondo blowout in the Gulf of Mexico. And they put that behind it now. It was a tough challenge for many years for them. They dished out billions of dollars, tens of billions of dollars actually, for damages. Took them a while to get the well under control, tremendous reputational damage. But now, 10 years later, it's pretty much behind them. So again, a record of resilience that is unmatched in almost any industry. In fact, the only thing I can think of is regulated utilities. That's in that same ballpark. Certainly ESG, many of you have heard of that, environmental, social, governance rules. That's become a very big deal in the investing world. And Fitch, Moody's, and S&P actually are now including ESG analysis in their credit rating analysis, which means that CO2 emissions, greenhouse gas emissions, regulation and all, that's going to be factored into credit ratings for super majors going forward. That may mean that Exxon doesn't earn Moody's top AAA rating at some point. But on the other hand, look at the resilience and look at, in legal area, these super majors have actually won a number of pretty noteworthy victories recently. One, New York State's attempts to turn ExxonMobil into the next Manville on, alleging a conspiracy to keep climate issues from the public. That's run aground from lack of evidence. So has Ecuador's effort to shake down Chevron over damages done to the Amazon by its national oil company after Chevron departed. So both of those cases, which were huge, had huge amounts of damages. The companies have worked through them. So again, that's another example of this group's resilience. And I would just say, summing up, I mean, the key to these companies' resilience: immense financial and physical resources, global reach, and management experience. Nobody's got more of it. They can basically choose to play in any market they desire and make their moves on a dime. And in fact, we're already seeing super majors investing heavily in things like LNG and solar, for example. If they want to own these markets eventually, they have the resources to do it. And another factor that, because of this, the flip side of companies cutting back on capital spending, is massive underinvestment actually in global oil field exploration and development. And it's really been, we've seen that since 2015. That's a point Elliott made in a recent issue of Energy and Income Advisor. It's in parts due to ESG. It's in parts due to collapsing oil prices. But the result of that is we could see oil prices again pushing toward $100 a barrel in the next few years. And that would be an incredible windfall for the super majors. It would be a windfall for other energy companies as well, but another big lift to their share prices, which I think are quite undervalued for all these prospects. In the meantime, they'll continue to pay we investors a rising stream of dividends in good times and bad, and I think that will lead again to rising share prices. One reason I wanted to present this graph to you of Chevron is it really gives you kind of a long-term perspective on these super majors and what sort of returns they provide. And it's also a personal experience. I invested in Texaco back in the 80s. I kept reinvesting dividends after the Chevron merger. And now what I put in there is worth more than 20 times what I put in. So I do also believe this is an instance where in investing where the past should be prologue for the future. And again, great group, particularly if you're conservative, particularly if you just want to invest, and they're paying biggest yields that I've seen in these stocks, particularly for this late in the bull market. So that's all I have for prepared remarks today. Thanks everybody for listening. And now we'll get to the questions. And again, please type them into the Q&A box. Type them into the chat box as well.
Great, thanks, Roger. And yeah, if you'd like to ask a question, I know we have a couple questions already in there, so we'll get to those in just a second. Just type it into the Q&A box, like Roger said, or the chat box. Also wanted to circle back around on our New Year 2020 special. As I said, we're raising the price of Energy and Income Advisor to $999 this year from $649, and the quarterly from $194 to $299. However, for special New Year's offer, we're still offering it at $649 annual or $194 a quarter. That does come with what we call our forever guarantee. And what that means is that it's not a teaser rate. If you choose to take on a trial subscription to Energy and Income Advisor between now and this Sunday, and you'll pay $649 should you choose to continue with that subscription. We'll never ask you for more than that. So we're raising the price to at least $999 this year. Maybe in future we'll raise the price again, but that won't apply to you. As an existing member, you'll continue to pay $649 a year for as long as you choose to remain a subscriber, or $194 a quarter. We normally offer a 30-day trial, but we're extending that to 90 full days. So take us up on this offer between now and Sunday night, and you get 3 full months to try out Energy and Income Advisor. Check out the portfolios. Roger mentioned some of them in his remarks. Also attend the monthly chats if you like to ask any questions. See the monthly issues that we come out with, twice monthly issues. Pretty much everything that Energy and Income Advisor has to offer. It's a normal subscription. Try it for 90 days. If you don't think that it's worthwhile, if you don't think it's worth every dime of the subscription price, just give us a call and cancel your subscription, and we'll refund the full price. If you'd like to join us for that, you can either use that web address on your screen, energyandincomeadvisor.com/December 19 special offer, or you can give our customer service manager, Sherry, a call at that toll-free number, 1-877-302-0749. Just tell her that you attended today's webinar to make sure that you get that discounted $649 offer. So with that, I'm going to go ahead and open up the floor to Q&A. I see some questions coming into the Q&A box. So why don't we go ahead and get started? First question I see here is, what are your thoughts regarding Suncor SU as a long-term holding? For example, 3 years. Well, Roger, you're Mr. Canada, so do you want to start with that one?
Yeah, absolutely. This is one we've had a buy for a long time, even in the kind of the depths of the depression, which Canada is still basically going, Alberta is still going through a pretty much an energy price depression right now. Last year, for example, the government actually uh, actually ordered producers to curtail their output. The problem is there's just not enough pipeline capacity coming out of that region. There's still a number of projects that look like they're going to be built at some point, but there's a tremendous, again, like I was talking about, midstream companies facing that political and regulatory opposition and opposition in the courts and so forth. Those are all kind of flashpoint projects, and even something like the Line 3 project, which involves basically taking out a lot of old pipe and replacing it with new pipe that's received, which you would think people would, might be supporting that, has been fiercely opposed and delayed several times. That project is Enbridge Inc.'s project, so it's a huge company backing it, and they're not backing down off of it, so they're still pushing it through. But again, that's been the problem for Canadian producers. And you look at what a company like Suncor, which is, of course, the biggest oil sands producer, what they can sell their output for compared to what a company in the U.S. can sell it for if they're using, say, a benchmark price of WTI Cushing. Tremendous discount there in those prices. And but the thing with Suncor, as opposed to a lot of many other players there, they're large. They also have the refining operation, so they are very well adapted to this lower for longer price environment, even in Canada, where it's much lower and for much longer in pricing. So even where you have companies like the former Penn West, it used to be the largest independent in Canada, and now sits very close to bankruptcy, really. They've changed their name to Obsidian, but they've dramatically downsized their operations since then. So Suncor's avoided that. They've done that, again, with scale, by being more or less something of an integrated company in the area. And I think that eventually, again, these pipelines are going to get built out of there, at least Line 3, very likely the Trans Mountain project, which the Canadian government actually owns, and is steadily pushing ahead with it. Keystone XL, possibly. Again, these projects are quite economic, and even with the delays, which of course push up costs, the demand for them is still quite acute. So, I do think the projects will go through, but let's say that they take a lot longer than people think, and that's certainly been the case so far. Suncor is in pretty strong position to continue doing what it's doing, continue producing profitably, continue driving down their costs, and as a result, again, we may not get that big breakout in the share price until those pipelines get built, but it's going to continue paying, I think, a pretty nice dividend yield. So again, that's one that we do cover in EIA. It's not currently in the portfolio, but it's one that I think I do think has some long-term merit if you're a patient investor.
Great. It looks like there were a couple comments there about the slide deck and the slides not advancing. I apologize if we were slow to move some of the slides, but hopefully everyone could see the slides that we had the slide deck okay. If not, I am going to send you a copy of the slide deck in PDF format tonight or tomorrow morning. So, you can look, if you couldn't see some of the detail, for example, you should be able to see it on the PDF.
I did keep that shale basin map up there for a while. Had a lot of information on it, but that I think that might have been relating to that. So that was, okay. Yeah. Anyway.
Yeah. Well, some of those maps, it's good to see the detail. So hopefully they can see that on the PDF too. The next question though here, what's our outlook on AMZA? The yield shows at 21%. Is this speculative, and would the yield be sustainable?
Well, I just looked at it. It's a ETF that actually owns a whole lot of options. So they write a lot of options. and that's how they have the yield at that level. It's kind of an unusual thing to see at an ETF. It's, I guess so, a little bit more perhaps, I don't know if you want to call it actively managed, but certainly the options introduce a whole new dynamic. I mean, these are primarily, if you look down the the list of what they've got here, they appear to be pretty much covered calls. So what those do, they're options to, well, a call option is an option to buy a stock at a certain price by a certain date. But so by writing the calls, they're basically betting against these stocks going up. Because if they did go up, then they would perhaps be called out of their positions. In other words, people would execute those call options, and they'd have to close them out. So that may be what's going on here with that 21% yield. Keep in mind that's not based on any kind of forecast. This is an ETF. It's not an actively managed fund for one thing, but it's based on the previous monthly yield, and they do pay it monthly, and it's been 8 cents a share. It was 11 cents a share the year before that. It was they paid quarterly at 52 cents, which means it was 13 cents the year before that. So it's been kind of steadily declining along the way, but I would definitely not count on that 21%. If that 21% did, depending on how they reckoned it, they would be liquidating a fair amount of the portfolio at that time. So in other words, it would, I think all those covered calls would probably limit the upside on this thing. Not really crazy about the ETFs in general on MLPs. I think, you've kind of in the past gotten the good and the bad and the ugly, with these things, some of the larger if you look at something like AMLP, which, one of the larger ones out there, their holdings right now are primarily the largest MLPs. I mean, they have Energy Transfer, MPLX, Magellan Midstream, Enterprise Products Partners, Plains, All American. Those are all pretty close to 10% of the portfolio there. So, it's very heavily concentrated in a few names. And why not just buy the names that you want instead of going with one of these ETFs? I think that way you can really control the risk a lot better. I do think a lot of these things are going to go up, so probably in 2020. So probably the ETFs are going to do okay, but I really do think you're going to get a lot more leverage picking your individual stocks. And certainly, again, something like AMZA with all these covered calls and so forth, it's at the very least, it's a far more complicated situation that you're stepping into than if you're just going out and trying to buy some MLPs or other midstream companies. And some of those, many of those companies on our high yield energy list aren't even MLPs. They're actually corporations. So if your reason for trying to buy another vehicle is to try to avoid the K1s and so forth, I think they would be a better way to go. But I think you just really want to be careful with any of these MLPs. And the next question I see here is MLP ETFs, and AMLP being another one. And again, this is one we look at sometimes in our trading service for potentially taking positions in. I would say it's preferable to AMZA in terms of if you're looking for something that can sustain its distribution. I don't see any of its holdings right now that are that I think will have a distribution cut. But we are going to see some of these taken off the board, and they're going to have to redeploy those. And when I say off the board, I'm talking about Tallgrass Energy, which is in the middle of the takeover situation right now. So again, I would definitely take a look at individual names over the ETFs.
Yeah, I mean, when you see something yielding 21% that owns a bunch of stocks that yield 6, 7, 8%, that tells you that there's something going on there. Either the fund is using leverage, or call options, covered calls or techniques like that to try to juice up that yield and make it more attractive. That's not, I mean, I'd have no problem with covered calls as a strategy. It's not something we really recommend in Energy and Income Advisor, but, I think that's a little bit gimmicky. The other thing I'd note is that, ETFs kind of market themselves, and in many cases it's true, right? You buy an ETF, you're buying like a broadly diversified basket of stocks. And that's true, right, in a lot of industries, right? So if you buy, like a semiconductor ETF, you're getting a broad basket of different semiconductor stocks. Problem I find is that with the MLPs, you're not really getting a diversified basket of anything. As Roger noted, I mean, if you look at most of them, like 3 stocks account for 40-50% of the entire ETF. So you're getting, I mean, you're basically putting your money in 3 stocks. And I think a lot of investors do that and don't realize that. So, they're not buying a diversified basket. They're buying, the 3 largest MLPs in size. So yeah, I totally agree. I mean, I think you're better off, buying the individual names. I mean, and I think that kind of segues into the next question here. Any thoughts on Magellan? Magellan Midstream Partners. I mean, it's been a name that we've liked, and it's one of the sort of big, well-diversified MLPs. It's been around a long time. Along with Enterprise Products Partners, which I don't think it's any big surprise to any of you to note that that's been one of our favorites for some time now. It's got a relatively low cost of capital. They were among the first to eliminate their incentive distribution rights long before anybody was talking about it, along with Enterprise. I think it's just a solid name. Their management is extremely conservative at MMP. I mean, they've walked away from a number of deals. I've noted in the last 4 or 5 quarters, right, where they were talking about building some new pipelines, but they couldn't get enough interest, or there were other MLPs looking to build in the same basic area, and they just walked away from the deal. I mean, I like that. Sometimes the stock gets hit, on the view that they have less of a growth inventory, but I mean, I like the fact that they're not chasing growth for growth's sake. So yeah, I do like Magellan. I don't know if you have any thoughts on that one, Roger, but I mean, that's been a name we've liked for some time.
Yeah, I mean, just that the only thing I would add to that is resiliency. I mean, pretty much Magellan and Enterprise are the 2 MLPs midstream MLPs I can name that were prepared when we went to this lower for longer energy price environment. And when I say that, I mean they were conservatively positioned enough with their projects. They hadn't adopted a build it and they will come mentality. They were focused on where the best economics were all along. Enterprise was focused on, of course, the export business, but Magellan, a lot of those very solid assets in Texas and so on, and stronger customers and so on. And that's I think that matters. I think we've seen how that matters. I mean, it hasn't taken off and run. Neither has Enterprise, but neither has the bottom dropped out, and they really didn't have to make any major adjustments, I think, in the last 5 years, other than just kind of progressively getting more conservative. So I think that does matter. And if anybody's concerned about companies, meeting the stress test, I think this is one that you can have a lot of confidence in, yielding around 6.5%. So that would be my thoughts on that one. I see the next one looks like long-term outlook on Inter Pipeline. That's another Canadian one. We also do, again, cover that in our international coverage universe. Has been I think a reasonably successful recommendation for us over the years. Not as easily accessible as Pembina, another play in that sec, which we continue to follow as well. But it's one of the very few midstream companies in Canada. They have about half a dozen, which contrasts to in the U.S. to many dozen, and as well as private capital. So I think that's really helped that business. In the Canadian midstreams remain pretty resilient throughout conditions in their core area, which are arguably worse than far worse than conditions in the United States. But it's so again, I think probably at some point a takeover for somebody, but pretty solid on its own basis. Increase the dividends every year. They just recently entered a venture with another major, with Pembina, to build a major Alberta petrochemical complex for processing NGLs, and it's a logical business for them to be in. So again, I think that like some of our other favorite Canadian midstreams, probably a topic for us to write up at some point. In very solid shape.
Yeah, absolutely. Well, I don't see any more questions in the queue, but I'll pause here for a little while and just in case anybody has any more questions. If you'd like to ask a question, you can type it into that Q&A box on your screen or that chat box on your screen, and we will answer it live here on the webinar. And if you do decide to take us up on the risk-free trial offer, as I said, every month, I think it's probably the most popular feature of Energy and Income Advisor. I think it's the one we hear about the most feedback on, is that once a month we log onto this website, and you can log on as well as a subscriber, and you type in any question you like, and we answer the questions right there in text format on the chat. Then we take all the Q&A, right? So all the questions and the answers, we load them onto a PDF file and send it out to you. So you get basically all your questions answered. You can email them in ahead of time if you don't want to go on the chat live. Ask any follow-ups you like, and we literally do answer all the questions we receive. I know in the past, in some months where there's been a lot of activity, especially back in when energy prices were coming down in 2014, 2015, we had some chats that Roger and I were answering. We answer all the questions ourselves, so we were online for 6-7 hours answering all the questions on the chat. So that's one of the favorite features of the service. So if you decide to take us up on that and come up with some more questions to ask, we'll be having one of those chats later on this month that you can attend. Looks like we got one more question coming in, asking about Kinder Morgan versus Energy Transfer long term.
Well, I mean, I like them both. I think they're both kind of in the sweet spot of midstream. They were companies that had to take fairly drastic action earlier on in the stress test, or whatever, if you want to call it that, or of the last 5 years. Obviously Kinder absorbing its various units in and then cutting its dividend. Energy Transfer cutting its dividend really twice at Energy Transfer Partners by basically merging ETP in first with Sunoco and then second with its general partner. But they've made the adjustments. The coverage ratios are great. The dividend growth at Kinder Morgan has been fantastic the last 2 years, and they've got another big one coming up. Energy Transfer, I think, will probably return to distribution growth this year. They have a coverage ratio almost 2-to-1. Most importantly, though, a lot of projects coming online. They've really kind of reoriented their businesses, I think, all those things that I talked about during the presentation, with companies, reducing debt, focusing on better parts of the business, shedding risk, be it operations or exposure to certain customers and so on. So they're big, diversified, and I think both of them are pretty much set up to be pretty big winners going forward. ET, of course, is a master limited partnership. KMI is a corporation, so that matters to some people in terms of their tax planning and so on. ET does pay a much higher dividend yield right now, though again, Kinder is about to really jack its up a lot higher in April. So, probably not as big of a yield difference as it appears, but those are really the primary differences. I know a lot of people look at both of those and say, well, I don't trust the principal owners. But I will say that, KMI and ET as well, they're both heavily owned by the people that founded them. And in Kinder, it's Richard Kinder, and in Energy Transfer, it's Kelsey Warren. And, I think you might be able to accuse them of being very aggressive at a point in the cycle that forced them to take big major steps, whereas Enterprise and Magellan did not have to take those steps. But I think, looking ahead, they're both certainly in great shape, great assets, and new things coming online in the next 12 months that will push up cash flow even more. So, I think they're both great and we do, again, cover those in EIA. Nothing's a buy to every price. I mean, we have been, particularly with Energy Transfer, we've been bearish on it at different times, bullish on it at others, I think. But with the stock at where it is now and the last few quarters of pretty favorable developments, again, we do like it.
Yeah, and it looks like the next question is, what do you think about First Trust Energy Infrastructure Fund? Roger, are you familiar with that one?
Not one that not one I know anything about. Pull up when we were on, when we do these, chats that you were talking about, we answer any and all questions, and often we learn about things that we didn't know about, and things that we might want to cover. So, like you say, it kind of goes both ways on these chats. We find it, we often learn about as much as hopefully our readers do.
Yeah, I see here. I just pulled up the holdings there, and it looks like the top holding is TC Energy Corp, and then Enterprise Products Partners, which we've talked about a lot. Yeah. Kinder Morgan, which we've talked about a lot. Next Era Energy Partners, which is one that Roger covers, but then also looks like some utilities there. Public Service Enterprise Group, Next Era Energy itself, the parent company. Got Enbridge, Plains GP Holdings, Magellan Midstream. Just looking down the list, and looking at the breakdown by sector, industry breakdown, electric power and transmission is the biggest holding. That's 38%. Roger knows that industry better than anyone. And then you got natural gas transmission and petroleum product transmission being 31% and 16%. Looking at the MLPs in there anyway, there's nothing, there's a lot of them are names that we like and we've talked about today. I don't know, Roger, what you think about the utility side of it, but.
Yeah, I would just say, why pay the fee? Why not just pick your own stocks? And, if you're on this call and you have the interest in finding out about the best investments, take advantage of them. Don't, just buy, because it doesn't sound like there's a whole lot of creative choices going on there. Just to be blunt about it, given holdings. Why not just buy them on your own? Don't pay the fee, have the control. And again, like I say, if you're taking your time to be on this call, I think that's probably where you want to come down. Why, take a little bit of time. Obviously we hope you pick up a copy of Energy and Income Advisor and read our stuff. We do have our actively managed portfolio. That's another I think, a really important feature of it. Not only do we show you what stocks to buy, we actually recommend allocations. So we're helping you with your risk management as well as, with just buying individual stocks. And I think that's actually a pretty unique feature of this letter. And in fact, of several of the publications we do take you down to that extra level of detail. Most publications I've worked on in my career have just been, basically you could call them just tout sheets. You just have a list of companies and they call them portfolios, but they're just basically lists of stocks. And when you do a portfolio performance, it's basically just the average of those stocks. So, which again is it's useful in that it points out good stocks, but it's left up to the investor to really kind of guess. And oftentimes people follow those publications that I've been in contact with over the years, and they wind up with certain stocks that are just, they've been winners, but they become like these inordinately huge pieces of their portfolio. So you wind up taking on quite a bit of risk if they should stumble at some point or another, which no company grows to the sky. So anyway, I think this is a really valuable feature. I think if and that's a place where I think you can find a lot better mix of and a lot better. I know, and I realize it's easy to just go out and buy a fund and leave it at that. But I do think that individual selection is going to become extremely important, and more important probably than ever, even in a context of some tailwinds with the overall sector. I mean, 70 midstream companies, that's a lot in North America. In Canada, you have about a half a dozen, and I really think that's been a huge factor in the fact that in making these companies so resilient has been there are just not so many of them out there. A lot of the MLPs out there, a lot of the midstream companies out there in the U.S. May look tempting, but could be traps. And if you tie your money up in one of these ETFs or even funds, you're really relying on somebody else to do it for you. I think the fund is a managed fund actually makes me feel a little better if somebody's talking about that. I just simply, with some of these ETFs, putting a portfolio together and just watching it roll for 3 months or whenever they do the adjustments, I think really does leave you open. But I really think that the value is much better for investors that are just going to spend a little time to pick stocks. And again, if you're on this call, I think that probably applies to you. And I see the next question here is about USAC, which is natural gas compression company. They compress the gas into various pipelines that it flows through. This is one that's actually owned and controlled by Energy Transfer, ET. They own right now about 48% of the common equity in this one. We have had this one as a buy at different times. I'm not sure where. It's a survivor definitely, and if you compare it to some of the other companies out there in the sector, I mean they've been remarkably steady. They have held their distribution, even though coverage has been relatively thin. It's about 1.08 times at the most recent look at it. But I don't know if you have any thoughts on the compression business. I think decent chance of them holding the distribution here at this point. But
yeah, I mean, it's got a high yield, so their cost of capital is 11 or 12% right now. So that's that's a little scary, but I think they're over the long term they've been a well-run name. A couple things I'd point out about the compression business is that it does tend to have some sensitivity to drilling activity. One part of their business, as Roger mentioned, is compressing gas to put it into pipelines, but another part of their business is actually on the production side. Compressing gas to re-inject it into wells to maintain underground pressure and production. And that is sensitive to drilling activity, and we are seeing a slowdown in drilling activity, and I think you're going to see that continue. In fact, I mean, I think one thing that people miss is that the slowdown in drilling activity, the bear market, if you will, in drillers, right, for example, it's actually very bullish for oil, because what it means is that these energy companies are not trying to increase production. They're doing exactly the opposite. So, I do think they have some sensitivity to that. I agree it's a well-run company. Obviously, as you can probably tell from our tone on this, I mean, it's not one of our favorites. But I think it's fair to say that in our model portfolio right now, we're much more focused on some of the larger names, that are, a little bit more, steady hands with a little bit better production coverage, distribution coverage. We do have some of the, Roger has some in his high yield energy list, which he mentioned to you in his prepared remarks. He's got some names that have yields almost as high as, or higher in some cases as USAC, but that we think are, have better prospects than USAC. So, if you want some of the bigger names, I mean, we mentioned, for example, Enterprise Products Partners, Magellan Midstream, we talked about those, but if you're looking for more yield, I mean, we do have some ideas, which we think have a similar yield to USAC, but are better positioned right now.
Yeah, absolutely. And we have also, again, just to remind you, we have what we call our game plan, I guess, and we're actually putting together a report for our readers where we're going to be looking at all of our top recommendations and where we stand with the game plan for this next year, because obviously, there's some movement where everything in a group goes up at the same time, but there also in a cycle, some energy stocks are going to start performing better earlier and faster. And if you follow this kind of a game plan, going with, in other words, timing yourself a little bit to the way a cycle will unfold that way, you can do a lot better than if you're just kind of randomly buying companies at any point in the cycle. So, some point USAC will probably see business pick up. But I mean, that's a good point you made there. I mean, looking at places where, natural gas is produced, I mean, the Marcellus Shale, for example, and I mentioned the lack of pipeline infrastructure out of there. There's another challenge that region's facing on the gas side, and that is the associated gas being produced with oil that's coming out of West Texas in particular. And in some cases, they're flaring this gas and just burning it off at the wellhead. And now they're building pipelines. Kinder Morgan just brought another huge one online in the latter part of 2019. They've got another one that is in the works, and that's a lot of gas now coming out that's just being produced because it occurs along with the oil that's being produced. So that may be less of a problem, as companies start to produce more within their means, but there is a lot of pipeline capacity coming on, and that means more gas coming out of that area. So that may benefit USAC in some places. It's not going to benefit USAC customers in other places. So again, I think there's a fair amount of risk behind what's going on here. I do think, like I said, they'll probably hold the dividend, but it is on our endangered dividends list because it is in that kind of a spot of vulnerability. And there will come a time when the timing will be better for that stock. But right now, like Elliot said, we're looking at companies that are going to benefit from this stage of the oil price cycle. And again, this report that we have had, I guess, the last two issues of EIA. One was very comprehensive in terms of what we see for the commodity. The second one that came out on December 28th was very much focused on individual sectors. So again, a lot of what we've talked about today, but in considerably more detail. And then this thing that we're coming out with, hopefully the end of this week, is more or less, kind of the action list for the game plan. So kind of a 3-part thing going into 2020. And obviously, if you become a EIA member, you'll be able to look at the whole thing and get an idea where things are going. We try to give you a little bit of a taste here, I think, in this presentation of what we do. And again, a lot of names out there, a lot of choices. We do strongly believe that taking control over what you're doing will have a tremendous impact in terms of your returns in 2020, certainly going forward as well.
Yeah, absolutely. So, yeah, I don't see any more questions in the queue at the moment. Just gonna check the chat queue here. I don't see anything there. So if you'd like to ask any more questions, I know we've been going now for a couple hours, so probably some of you are getting tired as well. But I'll leave it open here for a second, just in case anybody wants to ask anything. Okay, well, I don't see anything else here. We really did enjoy doing this today and answering your questions and presenting to you why we believe this is one of the best buying opportunities we've seen in energy since 2009. I know back in 2009, those of you who were around remember, oil prices had plummeted in the second half of 2008 and into early 2009. And there was nobody was interested in energy, really any stocks. And I remember Roger and I recommended a lot of master limited partnerships back then. They were yielding at that time in some cases upwards of, even Enterprise was yielding upwards of 10%. And it turned out to be one of the best buying opportunities of all time. I mean, if you bought back then, even in the heart of this bear market most recently for oil, you probably never saw your purchase price for most of those names again. And you continue to sort of collect dividends and distributions over that entire period. And I think in many cases, we're there again now. Roger mentioned their game plan, looking at different subsectors within energy that are going to benefit first from it. But again, I've never seen energy stocks more out of favor than they are right now, except maybe 20 years ago. When we were coming off that 1998 low in oil of just under $11 a barrel. And to be honest with you, I looked at valuations for a lot of these companies, and they're actually cheaper today than they were in 1998, 1999 in some cases. High quality companies, not fly-by-nights. So I do think it's the most compelling opportunity we've seen. I think you're already actually seeing you're seeing some of it show up in the market. Oil's already on the rise. As I said, it's up basically, it's up from it's up 20% plus from early October. I think you're going to see a little more upside in oil. People are beginning to realize that what the big shift we're seeing underway in shale. And we're also seeing some of these stocks start to react too. As I said, they had been underperforming oil by a sizable margin, but I look at a name like Concho that I mentioned. It was $62 back in August, which was multi-year lows. It's now at 87 almost. And I think it still could double from here up to around $180 being, sort of a normal valuation level for that of just a couple of years ago. These stocks are out of favor, but the fundamentals are turning. And to my mind, it's only a matter of time before the market starts catching on to that more and more, and you see these stocks start to go up a lot more, a lot faster. We think it's a great buying opportunity. I don't know how long it's going to last like this, but we hope to welcome many of you as new members of Energy and Income Advisors. I said we have this sale going through Sunday night, then we're going to have to close it down. We really can't leave it open too long because, as I said, we do these monthly chats, and if we have too many people on those chats, it becomes a little unwieldy. So we do try to keep the subscriber base, under a certain cap. So again, if you'd like to take us up on that offer, we're going to leave it open through Sunday night. Call the toll-free number or go to that website on your screen. Again, we hope to welcome many of you as new members in the very near future. I don't see any more Q&A, so with that, I'll call it a night. I hope everyone had a very happy new year and a profitable start to 2020. It's hard to believe we're in the 20s again, right? But we hope we hope to see many of you on as trial members and on our next chat later on this month.
Thanks, everybody.
Thanks, everyone. Good night.